In the early 2000s, General Electric was considered one of the safest investments in the world. A company so large, so diversified, and so respected that many believed it simply could not fail. At its peak, General Electric was worth more than $400 billion. It was not just a company, it was a symbol of American industrial power. And for decades, it delivered exactly what investors wanted: consistent growth, predictable earnings, stability. But behind that stability, something else was forming, a system that depended more on perception than reality. General Electric was not just an industrial company anymore. A significant part of its profits came from GE Capital, its financial division. By the early 2000s, GE Capital was responsible for a large portion of the company's earnings. In some years, nearly half of GE's profits came from financial services. On paper, this looked like diversification. In reality, it introduced a different kind of risk, one that was harder to see and easier to hide. Under the leadership of Jack Welch, General Electric became known for meeting or beating earnings expectations quarter after quarter. Welch himself was celebrated as one of the greatest CEOs in history. In 1999, Fortune magazine named him Manager of the Century. The media did not just report on General Electric, it amplified its reputation. It reinforced the narrative of perfection. Analysts praised its consistency. Financial news outlets highlighted its growth, and very few questioned how that consistency was being achieved. Because consistency at that scale is rare, and rare things should always be questioned, but they weren't. Instead, the story became too powerful to challenge. General Electric was safe, reliable, unshakable. That belief spread across the market, and once belief becomes widespread, it becomes dangerous, because it reduces scrutiny. And when scrutiny disappears, risk grows quietly. Inside the company, the pressure to maintain that image was constant. Quarter after quarter, expectations had to be met. And when real performance was not enough, adjustments were made. Accounting decisions, timing differences, financial structuring. Nothing illegal on the surface, but enough to smooth results, to maintain the illusion of consistency. GE Capital played a key role in that system. Its complexity allowed earnings to be managed in ways that were difficult for outsiders to fully understand. Losses could be delayed, profits could be accelerated, and the overall picture could be controlled. To investors, everything looked stable, but stability built on complexity is not the same as real stability. At the same time, the broader environment made things easier. Regulation of large financial activities within industrial companies was not as strict as it should have been. GE operated in a space that was not fully understood, not fully regulated, and not fully questioned. Government oversight existed, but it was not aggressive, not proactive, and certainly not designed to challenge a company like General Electric. Because GE was not just any company, it was deeply connected, a major employer, a key part of the American economy. And companies like that are often given the benefit of the doubt until it's too late. Then came the financial crisis of 2008, and suddenly the risks inside GE Capital could no longer be hidden. Credit markets froze, liquidity disappeared, and financial structures that once generated profit became sources of vulnerability. General Electric, the symbol of stability, needed help. In October 2008, GE received a $3 billion investment from Warren Buffett's Berkshire Hathaway, a lifeline at a time when confidence was collapsing. Shortly after, GE also relied on government-backed programs to support its funding needs. This was a turning point because it revealed something investors were not supposed to see. General Electric was not as safe as it seemed. The illusion had cracks, and once cracks appear, they spread. The company's stock, which had traded above $60 in 2000, fell dramatically. Years of perceived stability were erased. But the real damage was not just in the stock price, it was in trust. Because once investors realized that stability was managed, not real, confidence does not return easily. In the years that followed, General Electric began to unwind parts of GE Capital, selling assets, reducing exposure, trying to return to its industrial roots. But the damage had already been done. Billions in market value were lost, and the company that once defined safety became a case study in hidden risk. Looking back, the warning signs were there. Dependence on financial earnings, complex structures, perfect consistency, heavy reliance on narrative, but they were ignored. Not because they were invisible, but because they were inconvenient. The media played its role, highlighting success, reinforcing confidence, rarely questioning the foundation while everything was still rising. The government played its role, allowing complexity to grow without sufficient oversight, trusting that large institutions could manage their own risk. And investors played their role, choosing belief over skepticism, because believing was comfortable and profitable until it wasn't. General Electric did not collapse overnight like Enron. Its story is slower, more subtle, but just as important, because it shows that not all failures look like disasters. Some look like stability, right up until they don't. The lesson is not that General Electric was a bad company. It's that even the strongest reputations can hide fragile structures. And when media narratives, regulatory gaps, and investor belief align, risk does not disappear. It compounds, quietly, until the moment it becomes impossible to ignore. And by then, it's already too late. Because in investing, the biggest losses rarely come from what is obviously dangerous. They come from what feels completely safe.
If you enjoyed the content, subscribe to the channel so you don't miss the next videos. Leave your like and share. This helps the channel grow a lot. Thank you very much.